Good morning. These are the things that matter most in the U.S. market today. Wall Street futures are trying to firm after Mideast deal hopes eased crude oil pressure. Amazon has calmed part of the AI earnings debate. Apple remains a proof problem. Healthcare is back in focus. And the week still carries a major jobs report test. The central question for private investors is simple. Can Wall Street trust the bounce if AI leadership, oil relief, rates, and defensive sectors are all sending different signals at the same time? Start with Amazon, Apple, and the AI split. Reuters reported that Wall Street ended higher after Amazon helped soothe AI jitters, while the Wall Street Journal framed Amazon and Apple as the drama closing a turbulent month. That split matters because the market is no longer treating every mega-cap technology story the same. Amazon can support the AI narrative if cloud demand, backlog, and capital spending look credible. Apple can pressure the same narrative if product demand and China exposure look less convincing. Microsoft and NVIDIA remain important confirmation names, but the message is broader. AI can still drive the index, while punishing stocks that cannot prove the payoff. The cleaner side is Amazon-style cloud proof, Microsoft infrastructure demand, and NVIDIA-linked spending signals. Pressure sits with Apple-style product uncertainty, crowded high-multiple software, and any company where investors assumed AI would solve the margin problem automatically. For private investors, the practical takeaway is this. One strong AI earnings story can lift the tape, but it cannot validate every AI stock. Second, the macro backdrop is helping in a very specific way. Reuters and CNBC both pointed to Mideast deal hopes and lower oil pressure as part of the market setup, while investors are still looking toward the jobs report and the next economic data. Lower crude can reduce inflation anxiety, help transports and consumers, and give the market a little more breathing room on rates. But that does not mean the Federal Reserve story is solved. If labor data is too hot, yields can push back. If it is too weak, the soft landing story gets questioned. So the market is not just reacting to oil, it is testing whether lower oil actually improves the rates picture. Potential beneficiaries are airlines, transports, selected consumer stocks, and parts of the market that suffer when fuel or yields rise. Pressure sits with energy producers if crude relief becomes too aggressive, and with long-duration growth stocks if yields do not confirm the easier setup. For private investors, the useful filter is to separate oil relief from full macro relief. Those are not the same thing. Third, healthcare is back in focus as a Wall Street-specific defensive test. Reuters said healthcare was in focus as futures edged up, and that is important because defensive leadership can mean two different things. It can be healthy broadening if investors rotate into quality earnings and cash flow, but it can also be a warning sign if money is hiding from more cyclical or high valuation parts of the market. In a market already led by a narrow AI group, healthcare strength can either broaden the rally or reveal caution underneath it. The cleaner side is profitable healthcare, large-cap defensives, and companies with visible cash flow. Pressure sits with speculative growth, balance sheet-sensitive names, and sectors that need perfect risk appetite to work. In plain English, the takeaway is this. Defensive strength is not automatically bearish, but it should make investors ask whether the rally is broadening or hiding. The underappreciated story is market breadth. MarketWatch noted that the equal-weighted S&P 500 outperformed the Nasdaq 100 in July, while AI stock commentary remains central to the market. That is a useful warning. If the equal-weighted market improves while mega-cap AI leadership cools, the market may be rotating rather than simply breaking. But if breadth only improves because the largest winners are slipping, the headline index can become harder to read. The real question is whether leadership is expanding, not whether one index is green for a day. The cleaner side is breadth that comes with earnings support, cash flow, and sector confirmation. Pressure sits with rallies built only on short covering, oil relief, or one earnings headline. For private investors, the takeaway is that the best signal is not just Nasdaq versus the S&P 500. It is whether more companies can prove earnings quality at the same time. Here is the stock-led watch list. Amazon, Microsoft, and NVIDIA. Does the AI rally confirm beyond one earnings relief day, or does proof stay too narrow? Apple, Tesla, and high-multiple software. Do product demand and rates create pressure, or does risk appetite return? Exxon, Chevron, and United Airlines. Does lower crude become consumer relief, or does it simply weaken energy leadership? United Health, Eli Lilly and large-cap healthcare. Is defensive strength broadening the rally or warning that investors want shelter? Market bias. Cautiously constructive, but proof-led and breadth-sensitive. Wall Street can keep bouncing if AI proof holds. Oil relief supports the rate story, and healthcare strength broadens participation. But the mistake to avoid is treating every green futures move as a clean risk-on signal. The better filter is confirmation, AI proof, yield behavior, oil-sensitive sectors, and whether breadth improves for healthy reasons. That is the U.S. Morning Market Brief. We will be back tomorrow at the same time with everything that matters. Research context only. This briefing is not investment advice.